In this lecture, I'll talk about the features of debt securities. Debt securities are also sometimes referred to as fixed income securities. So first, some core features of a bond, and a bond is your typical debt security or fixed income security. And just to get some terminology straight, when we talk about a bond now in this segment, it will be from the perspective of an investor. So the idea is this: you might have a company XYZ. The company issues a bond. So when the company issues a bond and an investor buys this bond, what is happening is the investor is lending money to the company. So the investor lends money to the company and the company issues the bond to the investor. So the bond investor is also called a lender, and the bond issuer is also sometimes called the borrower. So you need to have this terminology straight. Now, in terms of this bond which the investor now has, so this is his investment, what are some core or most significant features of this bond? So you can think of this bond as a piece of paper which has been essentially issued by the company to the investor or sold by the company for a price. That price is the money that the investor has given the company or lent to the company. So this bond has a certain face value. That face value, let's say, is equal to 1,000. The face value is also called par value or maturity value. This bond will also have a maturity date. So let's say that maturity date is equal to 31st December 2015, and there are several other aspects too. So that gives us when the bond will mature. The maturity date is when the investor will get back face value. Then the bond will also specify a coupon rate. Let's say the coupon rate is equal to 10%, and along with the coupon rate it will be specified how often coupon payments are made. Generally, coupon payments are semi-annual. So this means that every 6 months the investor will get 5%, which is half of this annualized rate. There will be a currency denomination, so let's say that is US dollars, and then it will also be specified what the redemption mechanism is. So either at maturity versus amortizing, and very briefly, at maturity simply means that over the course of this bond, the investor will simply get coupon payments, and then at maturity, which is this date, the investor will get his face value back, which in this example is 1,000. And amortizing security, which I'll talk about in more detail later, basically is one where the investor gets both principal and interest back every period. Now let's talk about the bond indenture. So a bond indenture specifies the issuer's obligations. So when a company issues a bond, in other words, when a company borrows money, there might be certain obligations, and those obligations are called the bond indenture. Broadly speaking, the bond indenture or the obligations can be classified as negative covenants and affirmative covenants. Negative covenants are prohibitions on the borrower. Again, remember, I will use the borrower and issuer, this is the bond issuer, interchangeably. So negative covenants are prohibitions on the borrower, and the idea here is because of prohibitions such as this. So let's actually look at the negative covenants first. So negative covenants are prohibitions or things that the borrower / issuer is not allowed to do. So for example, there might be restrictions on asset sales. The point here being that as an investor, if I see the company that has issued the bond, if it starts selling assets, that will be a concern, because that might signal problems, and that might signal the fact that if the company is selling its assets today, it might not be able to pay me tomorrow. And clearly I would like to see a covenant that prevents the issuer from selling assets. There might also be restrictions on additional borrowings, especially borrowings that are senior to the debt which has been issued to me. And when I say me in this perspective, in this context, I am referring to myself as an investor. So clearly, as an investor, it will make me more comfortable if the issuer cannot borrow additional money, especially borrow money that is senior or has a priority over repayments that need to be made to me, the investor. We also can have what's called affirmative covenants. So these covenants are promises by the borrower of things that he will do. So when you have a covenant that essentially starts with the phrase issuer will, so these are promises of things that the issuer will do, these are affirmative covenants. Examples being maintain certain financial ratios. For example, the liquidity ratio might be, for example, the issuer might have to maintain a liquidity ratio greater than 1.5. Similarly, the issuer might have to maintain a interest coverage ratio of greater than 5. So I'm just making up numbers here, but clearly there are certain ratios that are important for the investor. In other words, the investor wants to ensure that the liquidity will remain relatively high, so coupon payments can be made, and investor also wants to make sure that the solvency situation of the issuer remains good, so that ultimately the principal payments can also be made. There might also be a covenant that says that there must be a timely payment of principal and interest. So essentially, covenants or promises that start with the phrase issuer will do so and so are affirmative covenants, and on a similar note, negative covenants will typically be prefaced with issuer will not, and then so and so. So for example, issuer will not sell assets, issuer will not issue additional loans, and so on. Now let's talk about different coupon structures. The very simple coupon structure that you've seen so far is essentially a fixed coupon. So this was a case where we have a face value of say 1000 and a fixed coupon rate of 10%. Then essentially, if this is semi-annual, then every 6 months the investor gets a fixed coupon of 5% of 1000, which is 50. But in the fixed income universe, we have many more coupon structures. So one is a zero coupon bond. So here essentially there are no coupons, and generally short-term government securities are zero coupon bonds. Take for example a 6-month T-bill. So with a 6-month T-bill, a 6-month T-bill is essentially a zero coupon bond, where let's say that at time 0 an investor buys a 6-month T-bill for 950. So this is the purchase price. If the face value is 1000, that essentially means the investor pays 950, and then 6 months later he will get back 1000. There is no coupon payment in between, but there is an implied interest because the invested amount was 950, and then the amount that the investor receives after 6 months is $50 more, which is 1000. Step-up notes are coupons where are bonds where the coupon rate keeps going up based on a formula that's defined up front. So for example, we might have a 5-year annual bond where the first coupon, let's call that coupon 1, is 6%, and then we say that every year the rate goes up by plus 1%. So the second coupon then would be 7% and so on. So this is a simplistic made up example, but the whole idea here is that the coupon rate goes up based on a formula that is defined when the bond is issued. A deferred coupon bond is one where no coupon payments are paid initially. So in essence, let's say again that we have a 5-year bond, and for the first 2 years no coupon payments are made. So if you have a 5-year semi-annual pay bond, then essentially we have 10 periods. So 1, 2, 3, and then 7, 8, 9, 10. So what might happen here is, if we have if we have a situation where for the first 2 years no coupons are made, then this would be called deferred coupon. So I'll just put in a 5 and a 6 over here. So essentially we are saying that in the first 4 periods, so from here till here, no coupon payments are made. However, the coupon amounts that should have been made at this time are deferred, and coupon payments are then made from period 5 onwards. But clearly the interest on these coupon payments will accrue. So effectively, in a deferred coupon bond, no coupon payments are made for a prescribed period of time, but coupon payments are made after that prescribed period is over, and the bond obviously is priced accordingly. This might be a situation for companies that do not expect to generate substantial cash flow, say in the first 2 years, but then are expecting to make money after that, and hence they get into a contract where they make no payments over 2 years and then make payments after that. Obviously I have used a 5-year bond and a 2-year deferred coupon, a 2-year period where coupon payments are not made, but that's just an example. We can have a bond for any number of years and a deferral period for any amount of time. Okay, next, floating rate securities. These are extremely important, and many bonds actually are floating rate, and these are sometimes also called floaters. The idea being that the coupon rate is tied to a certain reference rate. So you can have a reference rate such as CIBOR, which is the Karachi Interbank Offer Rate, or you can have LIBOR and so on. So in essence, with a floating rate security, you might say that the face value is equal to 1000 and the coupon rate is equal to CIBOR plus 1.5%, or sometimes this is expressed in terms of basis points. So this could be CIBOR plus 150 basis points. The idea being that, let's say you have a 3-year bond, and let's just make it 6 periods. So 0, 1, 2, 3, 4, 5, 6. The idea being that for every period the interest payment is based on CIBOR, or the benchmark rate, at the beginning of the period. So if at the beginning of period 1 CIBOR is 13%, then the coupon rate will be equal to 13 plus 1.5, which is equal to 14.5%. For period 2, we would see what CIBOR is at the beginning of period 2, which is the same as the end of period 1. Let's say CIBOR has gone down to 12%, then the coupon payment or the coupon rate would be 12% plus 1.5, which is 13.5%, and so on. So in essence, the coupon payment for every period is determined by the floating rate or the benchmark rate at the beginning of the period, plus whatever spread we have over that benchmark rate. Now, when you have a floating rate security, there might be a cap on that, on the rate. The cap is the maximum that the issuer is going to pay. So for example, if we have so if we go with the same example, there might be a cap of 15%. So this protects the issuer, because let's say that CIBOR keeps going up, and let's say CIBOR at this point, so this is the end of period 3, let's say that CIBOR has gone up to 14%. So if CIBOR is up to 14%, and if this were a regular floating rate security without any cap, then the coupon rate would be 14 plus 1.5, which is 15.5%. This might be more than what the issuer can pay. So to protect himself, what the issuer can do is set a cap of 15%. This means that no matter how high CIBOR goes, the maximum that the issuer is going to pay is 15%. So in this situation where CIBOR has gone up to 14%, if there is a cap of 15%, that means that the maximum that means that the issuer will basically pay 15% for this period. So hopefully it's obvious that having a cap is good for the issuer. Next, floor. This is good for the investor, because a floor puts a minimum on the coupon rate. So let's say that we have a floor of 10%. So this means that the minimum payment that the issuer has to make is 10%. In other words, let's say that CIBOR now goes down to 7%. So according to the formula that we have up here, the coupon rate would then be 8.5%. But if the coupon rate comes to 8.5% and the floor is set at 10%, this means that the issuer still needs to make a payment of 10%. So the floor is good for the investor. A collar means that a given bond has both a cap and a floor. So this protects both the issuer as well as the investor. More on floating rate securities. We can have a security or a coupon rate, or we can have a security called an inverse floater. Inverse floater means that as interest rates go up, the coupon rate comes down. How can this happen? We might have a formula such as 20 minus CIBOR. So the idea being that, again, for every period we look at CIBOR at the start of the period. So let's say for the start of period 1, let's say CIBOR is 12%, then this inverse floater will pay 20 minus 12, so it will pay 8%. Next period, if CIBOR goes up to 13%, then the coupon payment goes down to 7%, because where did we get the 7? It's simply from this formula, 20 minus 13 is 7, and so on. So notice that as interest rate goes up, coupon rate goes down, and obviously if the interest rate goes down, the coupon rate will go up. Inflation adjusted bonds. These are bonds where the payment varies based on inflation, and the way they normally work is as follows. In the US, these are called TIPS, or Treasury Inflation Protection Securities, and the idea is that for every period, the par value is adjusted based on inflation. So for example, if you have a par value equal to 1000 at time 0, and then over the first period there is a certain amount of inflation, you adjust the par based on inflation, and the coupon rate typically remains the same. So if the coupon rate is 5%, the coupon rate doesn't change, but when you do 5% based on a higher par value, obviously the coupon payment goes up, and there will be more details on this in a later reading, but I just wanted to plant the idea in your head. Now let's talk about the concept of accrued interest. Accrued interest is the portion of the next coupon interest payment already earned by the seller. To understand this concept, let's look at a very simple example. Say you own a 2-year annual pay bond. So at time 0 you buy this bond, and let's say that the bond has a face value of 1000. Let's say the coupon rate is equal to 10%, and when you buy this bond at time 0, the market rate is also 10%. So essentially you make a payment of 1000 at time 0, and the coupon payments that you are expecting for this bond are 100 at the end of year 1, 100 at the end of year 2, plus a $1,000 face value that you expect to get back at the end. Now say at the 6-month period, so after say about 180 days, you decide to sell the bond. So you sell the bond to another investor. The point now is the guy that you sell the bond to, he is the one who is going to receive this entire coupon payment of 100, but you actually held the bond for a 6-month period, or you held the bond for half a year. So clearly then you deserve half of this coupon payment. Now how do we deal with this? The amount that you have earned, or the amount that you deserve because you owned the bond for half a year, is called accrued interest, and the very simple formula for accrued interest is given right here. So accrued interest is the days since the last coupon. So in my example, that's from time 0 divided by days between coupons. So in my example, that is the full year. So in this example, essentially the first fraction simply becomes 1/2 multiplied by the coupon payment, which in my example is simply 100. So in this simplistic scenario, the accrued interest is equal to 1/2, which is, let's say, 180/360 multiplied by the coupon payment of 100, which is 50. So the accrued interest, which is the amount you deserve, is 50. And the point is, when the person you are selling to buys from you, he will typically pay you what's called a full price, and that is equal to the clean price plus the accrued interest. The clean price is simply at this 0.5 year mark. The clean price is the present value of the future cash flows. So if the market rate of interest has not changed, and let's say for simplicity that remains 10%, then the clean price will simply remain 1000, which will be the present value of these future cash flows. So the clean price is going to be 1000. The accrued interest that we just calculated is equal to 50. So the full price will be 1050. The full price is also called the dirty price at times.